Hi, thank you for watching us here at Tax Talk UK, where we talk about all things tax and consider other important aspects and issues of working for yourself, being a sole trader, running a small business. So today I'm just going to talk about incidental expenses or income relating to the VAT margin scheme. Before I do, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as being able to find other information that we have available on a whole host of different topics, all aimed at supporting you in your self-employment. So back then to the VAT margin scheme and other costs that are incurred. So we recently talked in more detail about the VAT margin scheme and whether that may be appropriate for you and how it works, if so. And on the back of that, we did have quite a few questions surrounding incidental costs. And so we thought that we would explain that in more detail. So one of the things to remember when you're operating the VAT margin scheme is the margin. We are talking about the margin on that item. So literally the sale and the cost that you get, the sale and the income that you get from that sale, and the purchase and the cost that you pay for that item. So that is different to the profit margin on that item, where you may include other costs such as any repairs on the item, any fees that you incur in advertising the item, shipping, and so on and so forth. So when you are calculating the VAT margin, you're simply looking at the sale to your customer and the amount to your supplier. So if, for example, you purchase an item but then you spend some money on renovating the item to make it saleable or to improve the value, then those renovation costs would be separate and you would claim VAT normally on those costs. So it would just be the actual amount that you paid for the item, the actual the cost of the sale, as it were, the cost of the actual item that you purchased, that would be your margin. Now, the other question that arose was, what if I bought things in bulk? So, for example, if you bought a bulk of 5 items for £1,000 and they're all pretty similar, there's nothing really to distinguish them, then you could simply split the £1,000 divided by 5 to get £200 for the purchase price of each item. It's really important, if you're operating the margin scheme, that you do keep comprehensive records of your sales and your purchases, a stock record, so that you can easily illustrate the purchase price. So I guess this is another way of being able to assess whether something is within or outside of the margin, as it were, because you potentially could purchase something depending on the trade that you're in, and that you could hold on to that stock item for sometimes a considerable amount of time, if not a number of years, before you actually make the sale. So it's just the actual cost that you pay at the time, and then the sale that you receive from your customer. And again, if you have to ship the item to your customer, but you're not charging them, that's a separate cost, that's all inclusive, then that would be the sale that you make. So the separate cost, so again, if you are advertising that item for sale, of course, then it's likely that the cost of that advertisement is going to be allowable as a business expense, but it wouldn't be included in the margin. So the margin is just simply the amount that you receive as a sale and the amount that you paid for that purchase. It's not relative to the profit margin. That would be a separate thing. So for the VAT margin, you're only interested in the gross profit, as it were. So hopefully this helps, and that explains that in a little bit more detail. Thank you very much for watching, and if you haven't already, please do subscribe to the channel. Thank you. Goodbye.